All right, let's talk about Newmont Corporation. You know, the biggest gold mining company on the planet. And right now, it is caught in one of the most interesting paradoxes you'll see on the stock market.
So first things first, just look at this. I mean, what an explosive run. After bottoming out back in 2023, the stock has just gone vertical, rocketing up an insane 147% just this year. On the surface, you think, wow, what a massive success story, right?
But, and this is where it gets really weird, what if I told you it's also considered a historic bargain? I know, it sounds crazy. How can a stock that's already shot up that high be a bargain? Well, that's the big mystery we're going to dig into.
So check this out. Here's clue number one. Even with that massive run-up, the stock is somehow trading at an 87% discount to its own 10-year average valuation. Let that sink in for a second. 87%. That's just a staggering number.
And here's the other piece of the puzzle. Its price-to-earnings ratio, that key metric for value, is sitting at just 12.7. For the top dog in a red-hot sector, that number is, well, it's shockingly low, almost unbelievably low.
And that right there brings us to the heart of this whole thing, a true stock market paradox. How on earth can both of these things be true at the same time? A stock that's soaring and yet somehow is also historically cheap.
To really see how wild this is, you need some context. Newmont is trading with a PE somewhere between 12 and 14. Okay. But the average for the rest of the gold mining sector, it's all the way up at 25.4. So Newmont is basically on sale for half the price of its competitors. It just doesn't add up.
And hey, if you're not super familiar with PE ratios, no worries. Just think of it like this. It's the price tag for every dollar of profit a company makes. So a lower PE means you're getting those profits cheap, like on sale cheap. And right now, Newmont isn't just on sale, it's practically in the clearance bin.
Yeah, and this quote from the original analysis just nails it. NEM trades at bear market PE multiples during a historic gold bull market, representing a severe valuation disconnect. I mean, think about that. The market is pricing Newmont like we're in a total crash for gold, when in reality, we're in one of the biggest gold bull markets ever. That's not just a disconnect, it's a chasm.
Okay, so you're probably asking, how did this even happen? Well, the whole story really starts with what you could call a billion-dollar hangover, and it all traces back to one massive acquisition.
This timeline lays it all out pretty clearly. It all kicks off in November 2023 when Newmont buys Newcrest Mining for a whopping $19.2 billion. That single move set off a chain reaction, one that dragged the company's earnings into the red for more than a year. It basically threw a blanket over the company's real value. You can see it right there. It took until the very end of 2024 for them to finally climb back into the black.
And this part is so important to get. The reason earnings went negative wasn't because the business was failing. Not at all. It was all because of these huge one-time accounting write-downs from that massive deal. Think of it like this. The company's true financial engine was running just fine, but the dashboard was temporarily broken because of these accounting quirks.
But that, my friends, is what leads us to the comeback story. Because once all that accounting dust settled, once those temporary effects faded away, the company's real performance was finally revealed. And honestly, it was nothing short of spectacular.
It was like a perfect storm for profits. You had gold prices screaming to all-time highs, over $4,000 an ounce. Then you had the company itself just printing cash, a record $1.6 billion in free cash flow every single quarter. On top of that, earnings per share growth just exploded. They launched a massive $6 billion share buyback to boost returns even more. And to top it all off, they were doing it all with a 24% cost advantage over everyone else in the industry. Just wow. And this chart just lays that disconnect bare. Look at that first bar. That's Newmont's valuation. Even after everything we just talked about, it's still completely dwarfed by its sector average and the S&P 500. It's like the market is still living in the past and just hasn't woken up to what's happening right now. Okay, this table right here is the key to understanding the paradox. Follow me on this. Look at the stock price column. It more than doubled from late 2024 to late 2025, a huge jump. But now, look at the earnings per share column next to it. It grew even faster. The company's profits were growing so explosively that they actually outran the stock price. And that's why the PE ratio, the valuation, stayed so low. The company literally got cheaper even as its stock was soaring. Incredible.
All right, I know what you're thinking. If this is all so great and so obvious, why hasn't the rest of the market figured it out? Why is this opportunity still here? It's a fair question. So let's talk about the risks and the reasons why some people are still skeptical.
It really boils down to a few things. First, there's still some nervousness about that huge Newcrest deal, integration risk. Then there's recency bias. That ugly period of negative earnings is still pretty fresh in everyone's mind. And let's be honest, gold miners as a group kind of have a stigma. They're known for being volatile. And finally, there's some guidance out there about a small dip in production coming in 2026. But the counter-argument, based on the analysis, is that the data tells a different story. When you look at the hard numbers, the insane cash flow, the smart asset sales they've made, their cost advantage, it suggests that most of these worries are either overblown, temporary, or already in the rearview mirror.
Okay, so let's tie this all together. Let's decode this opportunity and look at the actual strategy that the analysis lays out.
So the recommendation isn't to just jump in all at once. It's a more methodical 3-step plan. Step 1, start a position now, maybe about a third of what you plan to invest, just to get in on this historic discount. Step 2, be patient and use the market's choppiness to your advantage. Add another third if the stock pulls back a bit. And step 3, put the final third to work after the next earnings report, because the valuation could get even better.
And this is maybe the most compelling part, the risk versus the reward. It's what's called an asymmetric bet. The analysis sees the potential downside as being really small, maybe just 3%. But the potential upside? The base case is a 50% gain, and in a bull case, it's over 100%. So you're looking at a situation where the potential reward just seems to tower over the potential risk.
So how do we get to those numbers? Well, this table shows what happens if Newmont's PE ratio just returns to normal. If it just moves to a conservative PE of 16, that's a potential 40 to 50% jump in the stock. And if it goes back to trading in line with its peers, around a 20 or 25 PE, well, you're looking at the stock price potentially more than doubling from where it is today.
So, when you boil it all down, the final conclusion of this analysis is pretty clear. Newmont's current cheap valuation isn't reality. It's a statistical ghost. It's an anomaly created by that perfect storm of past accounting issues, and it's completely hiding the powerhouse performance that's happening right now.
And that leaves us with one last big question to chew on. When you find a situation like this, where a company's actual results, the fundamentals, are heading one way, and the market's feeling about it, the sentiment is heading in the complete opposite direction, where do you think the true value is really hiding?